If I told you that investing just $200 a month could matter, your brain will probably do one of two things. It will either say, "That's too small to make a difference," or it will say, "That sounds nice, but I don't really believe it." And both reactions are normal, because $200 a month lives in an awkward middle ground. It's not a life-changing amount, but it's also not nothing. It's the kind of number a lot of people could do if they made it a priority. And it's also the kind of number people dismiss because it doesn't feel dramatic. So here's the promise right up front. In this video, I'm going to show you the math of investing $200 a month in a way that actually makes sense to a beginner. Not the fancy chart version, not the perfect world version, the real world version that answers the question people actually have, which is, what does this look like over time? And why does it sometimes feel like nothing is happening at the start? Because the biggest mistake beginners make with long-term investing isn't picking the wrong thing. It's quitting too early because the early numbers look unimpressive. And in a moment, I'll show you the single reason the early numbers always look unimpressive, even when the plan is working. But before that, I want you to imagine something. Imagine you're filling a large water bottle with a teaspoon. The first few teaspoons don't change the level in a way you can notice. You could stare at it and think, this is pointless. But the teaspoon isn't the problem. The bottle isn't the problem. Your expectation is. Because the moment you expect a big, visible change early on, you're setting yourself up to feel disappointed by something that's designed to be slow at the start. Investing $200 a month is like that. It's not meant to impress you in month one. It's meant to build something quietly, over years. And if you can understand the shape of that journey, you stop needing constant reassurance. You stop checking every 5 minutes. You stop feeling like you're behind. And you stop treating investing like it's supposed to give you emotional feedback. In a moment, I'm going to walk you through the simplest mental picture for this math. But before that, let's clear one thing up. When people talk about investing, they often talk as if the only thing that matters is the return. But for normal people, the biggest driver early on is often not the return. It's the habit. It's the fact you keep adding, and the base grows. And then, later, the growth starts growing too. That's the part most people never feel because they never stay consistent long enough to experience it. So this video isn't about trying to predict what the market does next month. It's not about picking individual stocks. It's not about timing. It's about understanding the mechanism so clearly that $200 a month stops feeling like a guess and starts feeling like a plan. In a moment, I'll show you how to think about this in 3 layers: what you put in, what time does, and what behavior does. But before that, I want to ask you a question you can answer honestly. If you invested $200 a month for 1 year, would you expect it to feel meaningful? Most people say yes, because 1 year sounds like a long time. But in investing terms, 1 year is a blink. And that's where beginners get trapped. They run a long-term plan for a short period, then judge it like a short-term plan. And the moment you do that, you start making short-term decisions that damage the long-term outcome. In a moment, I'll show you exactly what those decisions are and why they're so tempting. Before that, here's the simplest way to hold this idea in your head. $200 a month is not a bet. It's a build. And builds work differently than bets. A bet is about being right at the right moment. A build is about showing up, placing another brick, and letting the structure grow. If you stay with me, you'll see the math in a way that finally matches real life. Slow early, clearer later, and heavily shaped by consistency. So let's do the calmest thing possible. Let's stop guessing and actually look at the math.
Before we go any further, I want to frame this properly because how you listen to the math matters just as much as the math itself. This is calm, educational finance content for beginners. It's not advice tailored to you personally. It's not a prediction. It's not a promise. It's a way to understand how long-term investing behaves when you contribute a fixed amount regularly. And that distinction matters because investing is one of the few areas where misunderstanding the shape of progress causes people to sabotage themselves. Most beginners don't fail because the plan was bad. They fail because they expected the wrong feedback at the wrong time. They expected early excitement from a system that rewards patience. They expected visible progress from something that compounds quietly. And when that feedback didn't arrive, they assumed something was wrong. So this video is about aligning expectations with reality. Now, a quick clarification in plain English. When we talk about investing $200 a month, we are not talking about a guarantee. Markets move, values go up and down. There will be periods where things feel flat, slow, or uncomfortable. What we are talking about is a general long-term mechanism. Regular contributions, combined with time, tend to create results that feel very different at year 10 than they do at year 1. That's not optimism, that's just how compounding works. Another important framing point. This video is not here to convince you that $200 a month is enough or not enough. Enough depends on your goals, your timeline, and your life. What this video is here to do is answer a more useful question. If someone did invest $200 a month consistently, what would the journey actually look like over time, and why does it feel the way it feels? Because once you understand the journey, you stop arguing with yourself every few months. You stop asking, is this pointless? You stop feeling like you're late. You stop comparing your beginning to someone else's middle. Now, there's another reason this framing matters. A lot of content online uses extreme examples. Huge monthly contributions, perfect consistency, best-case assumptions. That can make normal amounts feel insignificant by comparison. But normal investing doesn't happen in extreme conditions. It happens in real life. With rent, with bills, with changing income, with months where you're tired, distracted, or just busy being human. So the numbers we're going to talk about are not meant to impress you emotionally. They're meant to give you clarity. Clarity about pace, clarity about time, clarity about what matters early on and what doesn't. And one more thing that's important to say out loud. Early in an investing journey, most of the visible progress comes from you, not the market. That surprises people. They expect the market to do the heavy lifting immediately. But at the start, your contributions are usually doing most of the work. That's not a flaw, that's the design. And once you understand that, you stop feeling disappointed by early numbers because you realize they're behaving exactly as they should. So if you've ever thought, I've been doing this for months and it doesn't feel like much, that doesn't mean it's broken. It usually means you're still in the base building phase. In a moment, I'm going to show you how to think about this math in layers, so you always know which phase you're in. But before that, I want to set one more expectation. This video is long on purpose, because rushing through long-term ideas is how people misunderstand them. We're going to move slowly. We're going to repeat ideas in different ways. And we're going to keep coming back to real-world intuition. That's not filler. That's how understanding actually sticks. In a moment, I'll lay out the full roadmap so you know exactly where this is going and why each part matters. But first, remember this one sentence as we move forward. Long-term investing doesn't feel powerful when you start. It feels powerful when you stay. Now let's map out how we're going to get there. Here's exactly how we're going to walk through this, so you're never wondering where we are or why a section matters. We're going to break this into 3 clear parts, and each part answers a different beginner question. Part 1 is about understanding the core idea behind investing $200 a month. Not the numbers yet, the logic behind the numbers. This is where we talk about what actually drives long-term outcomes when you invest regularly. We'll slow this down on purpose. We'll explain why the early years feel quiet, why later years feel different, and why judging the plan too early is the most common mistake. In a moment, I'll introduce the first mental model that makes this click instantly. But before that, it's important you know what this part is not. It's not about tactics. It's not about optimization. It's not about trying to squeeze more out of the system. It's about understanding the system well enough that you stop fighting it. Part 2 is where we expand the idea using realistic beginner scenarios. This is the section where we talk about what usually goes wrong in real life. what it feels like in year 1, what it feels like in year 3. What happens when markets have a bad period? What happens when motivation dips? What happens when you start comparing yourself to other people? We'll walk through these slowly because most people don't quit investing because of math. They quit because of emotion. And in this part, I'll show you multiple ways to think about the same $200 a month so you can see how time reshapes it. There are 2 time-based illustrations coming here that are especially important. One shows why the early phase always feels underwhelming. The other shows why later phases feel surprising to people who stick with it. And before we leave this part, I'll walk you through what $200 a month actually looks like in a normal person's life, not a perfect one. Part 3 is where we translate all of this into behavior. This is where we answer the question, how do you actually do this in a way that doesn't drain your energy? Because knowing the math is not enough. You need habits that support the math. We'll talk about consistency, patience, and expectation setting. We'll talk about how often to think about it, how often not to think about it, and how to avoid the common behaviors that quietly sabotage long-term plans. And throughout all 3 parts, I'm going to keep opening and closing small loops. For example, in a moment I'll explain why $200 a month feels insignificant early on, even when it's not. Before we finish, I'll explain why people who invest for long periods often say, "I wish I'd started earlier," even if they didn't start with much. Those ideas are connected. And once you see the connection, the whole thing feels calmer. Now, one more important note before we move into the core concept. This video is not trying to convince you that $200 a month is the right number. It's a reference point. It's a number that's realistic for a lot of beginners. And because it's realistic, it's useful for understanding how the mechanism works. Once you understand the mechanism, you can scale it up or down in your own life. But you can't scale understanding if you never build it. So the goal of the next section is very simple. By the end of Section A, you should be able to answer this question without hesitation. What actually causes long-term investing to work, and why does it take time to feel it? In a moment, we'll start Section A by stripping this down to the simplest possible idea. No assumptions, no prior knowledge, just a clean mental model you can build on. Let's strip this all the way back to 0. No finance language, no assumptions, no shortcuts. Just the core idea behind what happens when someone invests $200 a month over time. Because if you don't understand the mechanism, the numbers will always feel confusing. And when numbers feel confusing, people tend to react emotionally. So we start with the mechanism. At its simplest, investing $200 a month means this. Every month, you are adding a small amount to a growing pile. That pile doesn't just sit there. Over time, it has the ability to grow on its own. But here's the first thing beginners need to hear very clearly. At the start, almost all of the growth you see comes from you, not from the pile. That's not a flaw, that's how it works. Early on, the pile is small, so even if it's growing, the growth looks small too. This is where people get confused. They expect the growth to feel meaningful immediately, but growth depends on the size of the base. Let's use a very ordinary example. Imagine you're saving loose change in a jar. The first few coins don't make the jar feel heavy. You can shake it and barely hear anything. If you judged the jar after 1 week, you'd say, "This isn't doing much." But the jar isn't designed to impress you in a week. It's designed to accumulate. Investing $200 a month works the same way. Now let's add the second layer. Over time, the pile doesn't just get bigger because you add to it. It can also grow because of what's already there. This is the part people call compound growth. In plain English, compound growth means this. The growth itself becomes part of the thing that grows. So instead of only growing on what you put in, it also grows on the growth that's already happened. That sounds simple, but your brain doesn't feel it naturally. Why? Because compounding doesn't grow in a straight line. Humans are very good at understanding straight lines. You do something, you get a result. You do it again,
you get a similar result. That's linear. Compounding is curved. It starts shallow, then it bends, then it steepens. And if you're not expecting a curve, the early part feels disappointing. So let's slow this down even more. When you invest $200 a month, there are three forces at work. The first force is contribution. That's you adding money. The second force is time. That's how long the money stays invested. The third force is growth on top of growth. That's compounding. Early on, contribution dominates. Later on, compounding becomes more visible. But beginners often expect compounding to dominate from the beginning. That expectation mismatch is what creates frustration. So here's the first core reframe. When you start investing, you are not watching your money grow. You are building the base that allows growth to matter later. That's a very different mental picture. Now let's talk about scale, because this is where $200 a month gets dismissed. $200 a month feels small in isolation. You might think, that's not enough to change anything. But investing doesn't work in isolation. It works in accumulation. $200 once is small. $200 repeatedly is different. Think about brushing your teeth. Brushing your teeth once doesn't transform your dental health. Brushing them every day for years does. The power isn't in the individual action, it's in the repetition. Investing $200 a month is a repeated action, and repetition plus time creates outcomes that don't look proportional to the individual action. Now, here's an important clarification. When we talk about investing $200 a month, we are not saying $200 a month will make you rich. We're saying $200 a month, applied consistently over time, behaves very differently than $200 applied once or sporadically. That's the lesson. Now let's introduce the first mental model that makes this click. Think of your investing journey like building a wall. Every month you add a brick. One brick doesn't look like much. 10 bricks don't look like much. But a wall isn't judged by the first row. It's judged by how tall it becomes over time. Now here's the key part. As the wall gets taller, every new brick adds height on top of the height that already exists. That's compounding. If you stop adding bricks, the wall stops growing. If you remove bricks, you reduce the height. And if you keep changing where you're building the wall, you never get height at all. This is why consistency matters more than cleverness early on. Now let's address another beginner misunderstanding. People often think investing is about finding the right time. So they hesitate. They wait for a better moment. They wait for more clarity. They wait for less uncertainty. But the math of investing $200 a month doesn't rely on perfect timing. It relies on repetition across many moments. Some months you add at higher prices. Some months you add at lower prices. Over time, those differences matter less than the fact that you kept adding. This is another reason $200 a month works as a mental model. It forces you to stop thinking in single moments and start thinking in sequences. Now let's talk about sequences. Imagine watching only one frame of a movie. It tells you almost nothing. But if you watch the entire movie, the story makes sense. Judging a long-term investment after 6 months is like judging a movie from one frame. It's not wrong, it's just incomplete. Now, another important concept. Your brain wants feedback. It wants to know if what you're doing is working. But long-term investing gives delayed feedback. This is uncomfortable. So beginners often substitute the wrong feedback. They look at short-term balance changes. They compare themselves to other people. They read headlines. None of those are good measures of whether a long-term plan is functioning. The correct early feedback is boring. It's this. Did you contribute this month? That's it. That's the only feedback that matters early on. Now let's slow down and talk about what over time actually means. When people hear over time, they imagine a vague future. But investing timelines have shape. There is an early phase, a middle phase, and a later phase. In the early phase, your contributions dominate the outcome. In the middle phase, contributions and growth both matter. In the later phase, growth can become a larger driver. This is why people who've been investing for a long time talk about it differently. They're not more optimistic, they're just in a different phase. Beginners often try to emotionally experience the later phase while still being in the early one. That mismatch creates doubt. Now let's bring this back to $200 a month. $200 a month in year one is not supposed to feel powerful. It's supposed to feel routine. That's the goal. The power comes from not stopping. Now let's introduce a second mental model. Think of investing $200 a month like pushing a heavy wheel. At first, the wheel barely moves. Every push feels like effort with little reward. But each push adds a tiny bit of momentum. And once momentum exists, the same push moves the wheel more. This is why people say compounding accelerates. It's not that the system suddenly changes, it's that momentum finally becomes visible. But if you stop pushing early, you never feel that shift. Now, another important reframe. People often ask, is $200 a month worth it? That's the wrong question. The right question is $200 a month something I can sustain without stress? Because sustainability is what allows time to do its work. A plan that you can follow for 10 years beats a perfect plan you follow for 1 year. Now let's talk about why the early numbers feel emotionally flat. Imagine you're climbing a very long staircase. The first few steps don't change your view. You're still basically at ground level. If you stop there and judge the climb, you'll say, "I'm not getting anywhere." But the staircase wasn't meant to give you a view on step 5. It's meant to give you a view after many steps. Investing $200 a month is climbing that staircase. You don't climb for the feeling of the first steps. You climb because you understand where the stairs lead. Now, one more thing that beginners need to hear. Investing $200 a month is not about how fast things change. It's about how hard it is to undo once time has passed. Once you've invested consistently for years, you've built something that has weight. And weight creates inertia. Inertia means it doesn't disappear overnight. That's where long-term confidence comes from. Not from excitement, from structure. Now let's summarize Section A in the simplest possible way. Investing $200 a month works because you are adding regularly. Time is allowed to pass. Growth is allowed to stack on top of itself. Early on, contributions matter most. Later on, growth becomes more visible. The plan feels boring at the start because it's supposed to. Boring is stable, and stability is what allows the math to do its job. In the next section, we're going to expand this idea using real beginner scenarios.
We'll talk about what it feels like emotionally in different years. We'll talk about the common doubts that show up. And we'll talk about why people who quit usually quit right before the curve starts to bend. But before we go there, take a breath and hold this thought. $200 a month is not small if it's consistent. It's only small if you expect it to perform like a short-term bet. Once you stop expecting that, everything about the math starts to make sense. Now that the core idea is clear, we need to slow this down even further and make it feel real. Because understanding the logic of investing $200 a month is one thing. Living with it emotionally over time is another. This is where most beginners struggle. Not with the math, with the waiting. So in this section, we're going to walk through realistic scenarios, common fears, and the exact moments where people usually start doubting the plan, even when the plan is doing exactly what it's supposed to do. And I want to start with something very important. Most people don't quit investing because it didn't work. They quit because it didn't feel like it was working. That gap between reality and feeling is what we're going to close. Let's start with the first realistic beginner scenario. Imagine someone who commits to investing $200 a month. They're motivated. They feel good about starting. They've done the right thing. Month 1 goes by. They've put in $200. They look at the balance. It's basically $200. Maybe slightly more, maybe slightly less. They shrug. That's expected. Month 2 goes by. Another $200 added. Now the balance is roughly $400, plus or minus small movement. Still not impressive. Month 3, month 4, month 5. At this point, a thought appears. This doesn't really feel like investing. It feels like saving. That thought is incredibly common, and it's also where people start making mistakes, because they think investing is supposed to feel different from saving immediately. But early on, investing and saving can feel very similar. The difference is not visible yet. This is where our first time-based illustration comes in. Think about a calendar, not a chart. If you invest $200 a month for 1 year, you've invested $2,400. In the context of your entire working life, that's not a large amount of time. So why would you expect a large visible outcome from such a short window? You wouldn't expect to learn a language fluently in a year if you practice 10 minutes a day. You wouldn't expect to master an instrument in a year with light practice. So why expect investing to feel powerful after a year? The expectation is the problem, not the plan. Now let's look at what happens next. Year 2. You keep adding. The balance is larger now, but still mostly explained by your contributions. And here's where the second doubt appears. I've been doing this for a while now. Shouldn't it feel more exciting? This is a dangerous moment, because excitement is not the feedback signal investing uses. Consistency is. This is where many beginners start comparing. They compare to people online. They compare to extreme examples. They compare to stories that compress decades into minutes. Comparison destroys patience. Now let's introduce the first mental model for this section. Mental Model 1, the iceberg. What you see above the water is the visible growth. What you don't see is the mass underneath. Early on, most of the iceberg is invisible. You're building something large beneath the surface, your habit, your base, your accumulated capital, but it hasn't risen into view yet. People quit because they judge the iceberg by what they can see too early. Now let's talk about scenario 2. This person invests $200 a month and then experiences a market downturn.
They check their balance and see that it's lower than it was a few months ago. They feel confused. I've been adding money, but the number is smaller. This feels unfair. So let's explain this in plain English. Markets move. Short-term movements can overwhelm small bases. When your base is small, even normal movement can make things look worse temporarily. This doesn't mean your contributions disappeared. It means the market moved. And here's the key point. When you're investing regularly, downturns are not automatically bad. Why? Because you are still adding at the same pace. That means you're adding when prices are lower as well as when they're higher. This is not something you need to optimize. It's just a natural consequence of consistency. But emotionally, this is very hard to accept unless you understand the timeline. So here's the second mental model. Mental Model 2, the escalator. Imagine you're walking up an escalator that occasionally slows down or even moves slightly backward. If you're standing still, the movement feels dramatic. But if you keep walking at a steady pace, the long-term direction is still upward. Investing $200 a month is you walking. Market movement is the escalator speed changing. You don't control the escalator. You control whether you keep walking. Now let's introduce our second time-based illustration. Imagine 2 people. Person A invests $200 a month consistently for 10 years. Person B invests $200 a month, but stops every time things feel uncomfortable. Person B might feel smarter in the short term. They avoid discomfort. But over long periods, stopping breaks the compounding sequence. Remember the wall from earlier. Stopping doesn't just pause the wall, it slows how tall it ever gets. Now let's talk about a very common fear. What if $200 a month just isn't enough? This fear usually comes from comparing yourself to imagined futures. But let's ground this. $200 a month is $2,400 a year. Over 10 years, that's $24,000 of contributions. That number alone matters. But more importantly, it represents 10 years of habit. And habit is what most people never build. Now here's where another misunderstanding appears. People think investing success is about starting big, but in reality, it's often about starting early and staying consistent. This brings us to the third mental model. Mental Model 3, the train. Once a train is moving, it's hard to stop. But getting it moving takes effort. Investing $200 a month is about getting the train moving. Once it's moving, adding more later is easier because the habit already exists. People who wait until they can do more often never start at all. Now let's walk through a real-life walkthrough. Imagine a normal person. They have rent, they have bills, they have a life. They decide that $200 a month is realistic. They don't stretch themselves painfully. They don't aim to impress. They automate the behavior mentally. Every month, $200 goes toward their long-term plan. Some months feel good. Some months feel boring. Some months feel uncomfortable, but they don't stop. After a few years, something changes. They don't think of investing as something they do. They think of it as something that exists. That shift is subtle but powerful. Now let's talk about what actually causes people to quit. It's rarely one big event. It's usually a slow erosion of belief, checking too often, comparing too much, expecting excitement. So here's a simple truth. If you invest $200 a month and expect it to entertain you, you'll be disappointed. If you invest $200 a month and expect it to quietly build something over a long period, you'll be aligned with reality. Now let's address another scenario. Someone invests for 2 years. Then life gets busy. They miss a few months. They feel like they failed, so they stop completely. This is a mindset problem, not a math problem. Compounding doesn't require perfection. It requires continuation. Missing a few months doesn't destroy the plan. Stopping entirely for years does. This is why patience and self-forgiveness matter. Now let's tie all of this together. Investing $200 a month is not impressive in any single moment. It becomes impressive in retrospect. When you look back after enough time has passed, people who stick with it often say, "I wish I'd started earlier." Not because the early numbers were exciting, but because they realize how much time matters. And this brings us to the most important insight of this section. The hardest part of investing $200 a month is not the money. It's staying emotionally aligned with a process that rewards patience, not excitement. Once you understand that, the doubts start to lose power. In the next section, we'll translate everything we've discussed into simple, beginner-safe behavior. We'll talk about how to actually live with this plan without constantly second-guessing yourself. But before we go there, hold on to this thought. If $200 a month feels slow, that doesn't mean it's ineffective. It means you're still early in the curve. And early is exactly where consistency matters most. Now we move into the part that actually determines whether any of this works in real life. Because understanding the math is not the same as living with the math. Most long-term investing plans fail here. Not because the idea was wrong, but because the behavior didn't match the idea. So this section is about alignment. How do you set up your behavior so that investing $200 a month becomes something you can live with for years, not something you wrestle with every few weeks? We're going to keep this calm, simple, and beginner-safe. No tools, no platforms, no tactics. Just principles that make the mechanism work. Let's start with the most important behavioral decision, the decision that silently controls everything else. You must decide in advance what this money is for. Not in vague terms, in time terms. Ask yourself one question, slowly and honestly. Can I leave this money alone for a long time without needing it? If the answer is yes, then this money qualifies for long-term investing behavior. If the answer is no, it does not. This is not about discipline, it's about realism. Investing money you might need soon creates constant tension. Every small movement feels dangerous. Every downturn feels personal. So the first rule of living with a $200 a month plan is this: only use money that belongs to your long-term future, not your short-term stability. This single decision prevents more mistakes than any other rule in investing. Now, once you've separated the money by time, the next step is habit design. This is where most people overthink. They ask questions like, what if I should wait for a better moment? What if next month is a bad time? What if the market looks uncertain? Those questions feel intelligent, but they quietly undermine the plan. Because consistency beats timing when you're working with long horizons. So instead of asking when the best time is, you choose a repeatable time. Monthly works well for many people because it matches how life works. Bills are monthly. Rent is monthly. Paychecks are often monthly. So a simple rule might be, once a month, $200 goes into my long-term plan. Not because the month is special, because repetition is. This removes decision-making. You're no longer asking, should I invest this month? You're simply following a rhythm. And rhythm matters more than motivation. Now let's talk about expectations, because this is where people sabotage themselves without realizing it. If you expect $200 a month to feel exciting, you will be disappointed. So you need to redefine what success looks like early on. In the early years, success is not growth, it's continuity. Did you invest this month? Yes or no? That's the metric. If the answer is yes, the plan is working. This feels almost too simple, but it's correct. Early on, your contributions are doing most of the work. The growth is there, but it's subtle. So judging the plan by the balance is misleading. Judging the plan by the habit is accurate. Now let's talk about attention, because attention creates emotion. Emotion creates action. And action can either support compounding or interrupt it. If you check your investments too often, you train your brain to react to noise. Daily checking is especially harmful for long-term plans. Why? Because markets move daily, and daily movement is not meaningful in a long-term strategy. So a key part of making $200 a month work is deciding how often not to look. A calm, beginner-friendly rule is this: only check when you contribute. If you invest monthly, checking monthly is enough. And even then, the purpose of checking is not to judge performance. It's simply to confirm the process is still running. Think of it like checking that a bill was paid. You're not reviewing the electricity company's strategy. You're just confirming the system did what it was supposed to do. Now let's talk about comparison, because comparison destroys patience faster than almost anything else. If you constantly compare your $200 a month plan to someone else's highlights, you will feel behind even when you're not. And here's the truth that beginners need to hear calmly. You are not competing with other people. You are competing with inconsistency. Someone who invests $200 a month consistently for years will almost always end up in a stronger position than someone who invests larger amounts sporadically. Why? Because compounding needs continuity. So the rule here is simple. Do not compare your early chapter to someone else's middle chapters. That comparison has no useful information. Now let's talk about what happens when life interferes, because life will interfere. There will be months where $200 feels uncomfortable. There may be months where you need to pause or reduce. This does not mean the plan failed. It means you're human. The danger is not adjusting temporarily. The danger is interpreting a temporary adjustment as a reason to abandon the system entirely. So the mindset you want is this: This is a long-term relationship, not a streak. Missing a month does not erase previous months. Reducing temporarily does not destroy compounding. Stopping for years because you feel like you broke it does. So if life tightens, you adapt calmly. You don't judge yourself. You don't quit. You resume when you can. That's how long-term plans survive real life. Now let's talk about the emotional moments that test people the most. The first test is boredom. After the initial excitement fades, investing $200 a month feels ordinary. That's a good sign. Ordinary is sustainable. If your plan requires excitement to continue, it's fragile. The second test is downturns. At some point, markets will have a period where values go down. When that happens, you will feel a pull to do something. This is where understanding the mechanism protects you. If your timeline is long and your contributions are ongoing, downturns are part of the environment, not a signal to exit. You don't need to feel good about them. You just need to not overreact. The third test is impatience. This is the voice that says, "Surely by now this should feel bigger." When that voice appears, remind yourself, the early years are about building the base. Judging compounding too early is like judging a tree by its first year. Now let's put all of this together into a simple lived routine. You decide that $200 a month is a sustainable amount. You assign it to your long-term future. You choose a monthly rhythm. You stop checking daily. You measure success by consistency, not excitement. You adapt calmly when life changes. You ignore short-term noise, and you keep going. That's it. That's the behavior that allows the math to work. Now here's something subtle but important. Over time, your identity changes. You stop thinking of yourself as someone trying to invest. You start thinking of yourself as someone who invests. That identity shift matters more than any number. Because once investing becomes part of who you are, not something you're testing, consistency becomes natural. And when consistency becomes natural, compounding becomes inevitable, not guaranteed, not smooth, but structurally supported. Now let's address one final behavioral trap. People often say, "I'll increase my contributions later when I earn more." That's fine, but only if later actually arrives. The purpose of starting with $200 a month is not that $200 is magical, it's that it builds the habit early. Once the habit exists, increasing later is much easier. People who wait to start until they can do more often never start at all. So the real power of $200 a month is not the number. It's the fact that it gets you moving. Now let's summarize Section C in a calm, grounded way. To make investing $200 a month work in real life, you need to choose long-term money, build a repeatable habit, reduce unnecessary attention, measure success by consistency, adapt without quitting, stay emotionally aligned with a slow process. If you do those things, you give compounding the environment it needs. Not perfection, environment. And in the final section, we're going to bring everything together and leave you with a calm, realistic way to think about $200 a month over a lifetime, without pressure, without urgency, and without unrealistic expectations. Let's slow this right down and bring everything together. Because if you've stayed through this video, the most important thing you should feel right now is not excitement. It should be clarity. Clarity about what investing $200 a month actually is. Clarity about what it is not. And clarity about why it feels the way it feels at different stages. Investing $200 a month is not a shortcut. It's not a dramatic move, and it's not supposed to impress you early on. It's a long, quiet build. It works the way most meaningful things in life work. Slow at the start, unremarkable in the middle, and powerful only in hindsight. Early on, almost everything you see comes from your own contributions. That's normal. Later on, something subtle changes. The growth itself starts to matter more. Not because you did anything differently, but because you stayed long enough for time to stack. That's the part people miss. They judge a long-term plan using short-term feelings. They expect feedback too early. They expect excitement from a system designed for patience. And when that excitement doesn't arrive, they assume something is wrong. Nothing is wrong, they're just early. So if there's one sentence to carry forward, let it be this. Investing $200 a month doesn't feel powerful while you're building the base. It feels powerful once the base exists. Your job is not to rush to that feeling. Your job is to make sure you don't interrupt the process before it has a chance to show up. That means measuring the right things. Not, how impressive is this right now? But, am I being consistent? Not, is this exciting? But, is this sustainable? Not, am I ahead of others? But, am I still in the game? Because long-term investing doesn't reward intensity. It rewards continuity. And once you understand that, $200 a month stops feeling small. It starts to feel like what it really is. A repeatable action. A quiet habit. A foundation you're laying brick by brick. And the people who benefit most from investing are not the ones who found the perfect moment. They're the ones who didn't keep restarting. They didn't demand that the plan entertain them. They didn't abandon it during boring phases. They didn't panic during uncomfortable ones. They simply kept showing up. Now, in the next video, we're going to build directly on this. Because once you understand the math and the behavior behind regular investing, the next natural question is this. How do I think about risk without fear, so I don't sabotage myself when things move? That's what we'll explore next. Not in a dramatic way, not in a technical way, but in a calm, beginner-safe way that helps you stay consistent when uncertainty shows up. Because when you understand risk properly, investing $200 a month stops feeling like a leap. It starts feeling like a long walk you know how to stay on. I'll see you in the next one.